Kim Parlee, it is great to have you with us tonight. There's been a fair bit of negativity around the Canadian growth prospects over the last few months, which has led many to ask whether a recession could be coming. Our next guest just published a paper on this and says there is a risk that Canada's economy could stagnate even as the U.S. economy appears healthy. He coined the paper Canadian Solo Recession Risk, Rhetoric versus Reality. Brian Depratto is senior economist at TD Bank. He joins me now. This one caught my attention. It caught my attention in not a good way. So let's just go with the title, Solo Recession Risk. Is it possible?
It's certainly possible, but we have to be very careful about what we mean by recession. There's sort of two broad categories, right? There's the capital R recession, we're talking 2008, 2009. And then there's also more of the risk of stagnation or sort of technical recession, a little bit more like 2015, 2016. We think that latter one, the risk is more real. But in terms of that big capital R, we're not seeing that just yet.
Okay, and I guess the interesting thing here is the word solo in this, is that, usually when we have this kind of situation, it's because something not great is happening in the States, and that's not what's happening right now.
That's exactly it. That plays into it. If you go back and look at, basically since the 1950s, we've never had a recession in Canada without the U.S. also going into a downturn, with one very odd exception during the Korean War. So, that's part of the reason why we don't think, a big broad-based downturn is coming, because it's very unusual to have that external channel go off when the U.S. is still doing quite strongly. Mm-hmm. But, a growth slowdown, a modest contraction, that's where the risk lies.
Okay, let's go through some of the data then in terms of even where you see a technical recession being possible, because I know we had some pretty good jobs numbers in February. That might be an outlier in terms of everything else we've been seeing. So let's run through some things you talked about. Inventories, you think they're piling up?
Absolutely. If you look at the stock to sales ratio, both sort of broadly defined, you go into the manufacturing sector, wholesale trade, those levels are very, very elevated. We've had very poor sales performance, mm-hmm. Exports. So you're getting that build up there. That's something you typically see ahead of a downturn.
What about, I hear you've got here domestic challenges significant. I'm assuming, what does that mean beyond the inventories? Is this mortgage, credit, that good stuff?
That's it. Let me kind of go down the list.
Okay.
You hit the nail on the head there.
Yeah.
The mortgage credit, consumer credit more broadly.
Yep.
Credit's a little bit sort of like the lubricant of the economy. You don't want too much in there, but you need a little bit in there to make the whole system work. And we've seen those numbers trend down to a pace we haven't seen basically since the early 1980s. Mm-hmm. So consumers pulling back, you see that in the GDP data, speaks to some of the sales side of things. And then related to that as well is real estate. Toronto, Vancouver, those key markets, Calgary as well, still seeing some soft data. The early reports from Toronto and Vancouver for February, not super encouraging. So it seems like that market's still getting its footing. So you have a few of these segments that are kind of, they're not down or anything, but they're stumbling a little bit, and that's where we see the concern.
I mentioned the numbers that came out in terms of the jobs numbers. How is labor looking? I mean, labor ultimately is a reflection of the economy. I mean, people are employed when they have somewhere to be employed. So how's it looking?
It stands out, but I'm reminded of that saying, the nail that sticks out gets hammered down. The reason I think that applies here is because when you look historically again, this labor markets, they tend to be somewhat of a lagging indicator. What we mean by that is that you typically see, GDP start to turn a little bit, sales, other measures, and then you see the labor market kind of catch up a little bit. We saw good job growth, not that this should be the precedent, but you go back to 2008, 2009, it wasn't until about a quarter of the way into that downturn mm-hmm. that you saw the labor market really turn. And even beyond that, there's some aspects that don't get as much attention that are a little concerning. So we've had these very, very strong jobs numbers over the past few months. But at the same time, the aggregate hours worked, so that's all the hours everyone in the economy is putting in, that's actually declined for 3 straight months now, which is a little bit unusual, and again, a little bit of a warning signal.
And what does that mean? So it means, again, so just translate again, like aggregate hours, it means we're working less, even though there's more people working?
That's exactly the interpretation. So, more people are employed, that's absolutely a good thing, and even, a little bit of mystery, more full-time work. And yet, within the overall, people are maybe not choosing. We're seeing a little less hours put in on average across everybody. So even as more people are out there, we're just getting a little less oomph in terms of, hours at the desk, hours in the factory, that sort of thing.
Yeah, productivity, and I guess that means needing less people later on too. But we'll just kind of that could be another extrapolation. You've got here with your piece that you put together. Don't rule out psychology here. Is that a positive or a negative to what you're saying?
I think that's a negative. It's a little bit of the wild card for us.
Yeah.
This is something that our chief economist has also written on, this idea of a Beetlejuice type recession, where you get sort of, individual people decide, things are kind of turning down. I'm going to adjust a little bit. I'm going to pull back, and other people start doing it. Don't eat out, that sort of thing.
Yeah.
And individually, that can be rational. But when everyone starts doing that, suddenly the spending slows. And spending, of course, about 60% of our economy. Suddenly you get growth slowing, and you can get a downturn as a result of that.
What are you going to be watching? I mean, because it sounds as though you're watching, and you're saying, we could see a technical recession, we don't see a big one, but we're watching for signs of a downturn. So you've talked about a number of things here where you've seen that point to the evidence of where we are right now. What are going to be like 2 or 3 things you go, yeah, that's something we do need to pay attention to?
The big one, of course, labor markets.
Yeah.
I would really love to be wrong on that.
Me too, by the way. I'd like you to be wrong as well.
See that, that relationship be a little bit different there. The credit side for me, that's significant. And on the labor market as well, we're also looking at unemployment claims. That's often a little bit of a leading indicator, something that moves ahead of other things. So far, it's been less than encouraging, but not so bad. That's definitely one we're going to be keeping a very close eye on.
I know we're going to be talking to you later. We're going to be covering, of course, the budget when it comes out next week, and no one really knows a lot of what's going to be coming out. Is that something that you think could have a material effect in terms of where the Canadian economy goes? I mean, you have a little kind of political unrest. You can have changes of parties. I mean, lots of things can happen. Is that another thing that could kind of just, slow things down, throw a monkey wrench in the works?
It really depends on what we see next week. The government we have right now has been willing to sort of, spend the benefit. We've had pretty strong growth through the past few years,
yeah,
and they've ramped up spending through that. So from that perspective, I'm not sure we're going to see a big pullback. That'd be what would be more concerning. Is, not that we do need to get to balance or keep that debt trajectory downwards, but a rush to get there isn't the way to do it. And I think that would be the risk. But I think for now, that risk is fairly minimal.
All right. Well, Brian, we're going to leave it there, and we will talk to you again next week. Thanks so much.
Thank you.